There are very reliable and consistent patterns that play out when a stock is about to experience a bullish move. Here are a few of my favorite patterns, but make sure you watch till the end as I'll reveal exactly what not to do with these patterns. So number one is the cup and handle, and this is one of my favorite continuation patterns, and it's characterized by a move up first and followed by a pullback and consolidation, and then another move up in which we back off and pull back slightly before moving higher and breaking out, forming a cup and handle in the process. Here's an example of the cup and handle with Google. Move up, sharp move down, consolidation, move up, slight pullback, push higher, and then breakout. So the inverse head and shoulders pattern is used to spot a potential trend reversal when a stock is in a downtrend. It is characterized by making a low, followed by a lower low, and then finally a higher low, completing the head and shoulders pattern. Now, many traders will use this pattern to calculate what is called a measured move, where the distance between the neckline and the head is about the same amount of price movement that you can expect to see on the upside when the pattern plays out. A double bottom is a classic pattern that is signified by price putting in a low, trading higher before pulling back to that same level and then reversing higher. Now, while this pattern is fairly reliable, I like to couple it with the RSI indicator. Now, what I'm looking for is a bullish RSI divergence where on the first pullback, the RSI makes a low, but on the retest, it makes a higher low. This shows that there wasn't as much selling pressure on the retest and the buyers are beginning to take control. Now, as you can see with Rivian, we didn't get the RSI divergence, but this pattern can still be traded. Just make sure that you set your stop accordingly. The Morningstar reversal is one of my favorite and most reliable chart patterns that is pretty easy to spot. It's characterized by a red bar with a move down, a gap down into the next session forming a doji before gapping up in the following session and forming a nice bullish bar. This pattern forms at the bottom of a downtrend and signals that the sellers have lost control and that the stock is likely to reverse. Now, just looking at this chart of Micron, you can see that every time we get a little overextended on the downside, we put in this formation. And lastly, we have the bull flag, which is a classic continuation pattern. This formation starts with a strong move up forming a flagpole, followed by a period of consolidation forming a flag, before eventually breaking out to form a new swing high. So you have to remember that technical analysis is more of an art than it is a science. You can't just jump into the market and buy every cup and handle or double bottom that you see. You have to couple this with a fundamental view of the stock and the market to feel confident to use these patterns.